Welcome to the Wells Fargo Investment Institute State of the Markets Monthly Roundtable for June 10th, 2026. Before we begin, please note the following disclosures. The opinions expressed in this call reflect the judgment of the speakers and are subject to change without notice. The material has been prepared for or is distributed solely for information purposes and is not a solicitation or an offer to buy any security or instrument or to participate in any trading strategy. Past performance is no guarantee of future results. Additional information is available upon request. Investment and insurance products are not insured by the FDIC or any federal government agency, are not a deposit or other obligation of or guaranteed by the bank or any bank affiliate, and are subject to investment risks, including possible loss of the principal amount invested.
Hello, everyone, and thank you for joining us today for the State of the Markets Roundtable call. I'm Tracy McMillian. I'm the head of Global Asset Allocation Strategy for the Wells Fargo Investment Institute, and I'll be moderating our call today. And with me are three of our very talented senior strategists. We have Veronica Willis, who is a strategist with the Global Asset Allocation team, Samir Samana, head of our Global Equity and Real Asset Strategy, Brian Railing, head of our Global Fixed Income Strategy. So today is a great day to have a State of the Markets call. We had new fears hit the market as investors are worried about a re-escalation in the war with Iran. Since the start of June, markets have snapped a 9-week positive streak, and they're off their all-time highs. Equities have been a lot more volatile in the past 2 weeks. They've been reacting to rising inflation, higher interest rates, and the question about the sustainability and productivity of all this AI spending that's going on. We'll discuss all these concerns and how we see them impacting markets going forward. But first, I'd like to highlight a couple of our recent reports and one upcoming report for next week. First of all, Darrell Cronk, who is our Chief Investment Officer, wrote a State of the Markets last week called Independence, Uncertainty in Markets, Lessons from 250 Years. So in this report, it's a bit longer than Darrell's usual State of the Market report, but it's a really good history lesson here on the eve of the 250th anniversary of the United States independence. And it talks about how the clash between Hamiltonian ideas and Jeffersonian ideals continue to play out. And we see that in U.S. politics, we see that in U.S. society, and Darrell does a really good job of tying that back into the economy and the markets and how it's playing out in those areas as well. It's a really interesting read, and if you haven't seen it yet, please contact your advisor and ask them for a copy. And then the second report that I wanted to highlight is coming out on Tuesday, June 16th. It's our 2026 Mid-Year Outlook Report. It's one of the two biggest reports that we release in a given year, the Outlook and the Mid-Year Outlook. And it's called Keeping Discipline in Noisy Markets. So on Tuesday, ask your advisor for that report. It will also be available on WFA.com. And then the final thing I wanted to highlight here was our 2026 Mid-Year Outlook call. 1 week from today, on June 17th, please join Darrell Cronk, who's our Chief Investment Officer, and our asset group heads, and I'll be on that call also. And we'll have a live discussion about our mid-year report and our outlook for the rest of this year and into 2027. So getting back to markets, markets were down across the board today on concern of another escalation in the war with Iran. The S&P 500 gave up about 1.6% today. NASDAQ was down 2%, and the Dow was down 953 points. Oil climbed back up to over $90 a barrel. Gold tumbled 4.3% to $4,099 an ounce. And we're coming off of a really stellar earnings season. In the first quarter of this year, earnings were up 28%, and that pushed U.S. markets to all-time highs, and that rare 9-week positive streak that was just broken last week. Now investors are starting to worry that we may have just gone too far, too fast, and markets are again turning their focus back to the war headlines, and they're questioning technology stock valuations. And of course, meanwhile, we have massive IPOs on the horizon, with the largest initial public offering ever expected to start trading on Friday. And investors are likely selling some of their winners ahead of that IPO to fund investment in it and several others that are coming to market later this summer. So are these conditions setting us up for a summer of volatility? We'll talk to Samir later in our conversation about that. The renewed escalation in the war also puts a possible deal on the back burner for now, and that, of course, is leading to those higher oil prices today, along with renewed inflation concerns. The Federal Reserve meets under its new chairman, Kevin Warsh, next Wednesday, amid rising expectations for a rate hike at some point later this year, and we'll get a preview of that upcoming meeting from Brian. Despite the market's wobbles that we've seen in June, economic news has been pretty solid. For example, if we look back at last week's payroll employment numbers, they increased by 172,000, which was nearly double the 88,000 that we were expecting. The stronger data is pointing to a U.S. economy that's remain very resilient despite the political conflict, and that has all but halted about 20% of the world's oil, which typically is flowing through the Strait of Hormuz. But the supply shock in the oil markets represents a risk that's showing up in inflation data and also in consumer behavior. Today, we saw inflation rise as expected, 4.2% over the last year. And that's the highest rate that we've seen in 3 years. And of course, that's mostly because of higher energy prices. But even the core rate, which does exclude energy and food, which tend to be the most volatile components, that was also up 2.9%, which was meaningfully above the Fed's 2% target. And with inflation rising to these levels, it's going to be really hard for the Fed to continue to cut rates. So we'll hear from Brian later on his expectations for rates. Consumers are also feeling the pain of inflation that's rising more than their wages are rising. We also got numbers on average hourly earnings today, and they fell for the second month in a row. Just to give you an example, earnings were up 3.4% over the past year, but inflation climbed to that 4.2% over the same time period. So wages just haven't been keeping up with inflation. And consumers represent about 70% of the U.S. economy, and they've been supported so far this year by tax refunds, but those have largely gone toward paying for those higher energy expenses, higher gas prices, and they're starting to be exhausted. So what we're seeing now is savings rates drop, and we're seeing credit card balances and delinquencies starting to rise. But that's really affecting just the lower end of the income spectrum of consumers. Consumers on the upper end of the income spectrum are continuing to spend, and their spending is really being supported by higher asset prices. The ongoing Iran conflict does remain a headline risk and continues to impact markets mostly over short periods of time because it really hasn't yet emerged as a sustained market disruptor. And this is, of course, consistent with market behavior around those historical energy crisis events. In those cases, what we've seen is that markets tended to absorb geopolitical shocks pretty quickly and then move on to more relevant market factors like earnings growth. And how long this conflict lasts is another critical thing that we're watching. And in some parts of the world, energy supply disruptions are already resulting in demand destruction. For example, in India, employees are being urged to work from home in order to conserve fuel. We're probably not going to see that here in the United States because the U.S. is an energy exporter, and we're seeing less impact from the war and from higher oil prices than countries that are energy importers, which in addition to India, also includes most European countries and Japan. And the worry really is that demand destruction in those countries probably is going to mean slower global growth. Another risk we're keeping our eyes on is that renewed military escalation could prompt the Fed to consider raising rates. Earlier this year, markets were pricing in rate cuts. Now they're pricing in 1 to 2 hikes following today's news. So if that were to come to fruition, higher rates would very likely slow growth here in the United States and possibly strengthen the dollar as well. But despite these risks, what we're seeing so far this year is performance that has been pretty positive for stocks. Emerging markets are the best performing major asset class this year. They're up 24.9% through yesterday's close. And while the S&P 500 closed down today, it's up about 7% through today's trading. We're seeing the leadership trends in the S&P 500 continue. AI mega caps have continued to provide that market leadership through most of this year, despite some weakness over the past couple of weeks. But breadth does appear to be improving modestly, but it's relatively uneven still, with those technology names being the best performers on the year to date. And then in global markets, what we're seeing there is pretty strong international outperformance, especially in those emerging markets that I mentioned. Fixed income markets, we've seen yields that have been rising so far this year, and so that's setting us up for some negative returns, especially in treasuries and developed market bonds. High yield and muni bonds are still positive so far this year. And rates really do remain very tied to inflation, and because inflation has been rising, we've been seeing the same thing happening there with rates. Commodities, I'll wrap up my comments here and move on to bring our panelists into the conversation, but I did just want to mention that in the commodities space, we are seeing industrial metals benefiting from AI and infrastructure demand, even though we're seeing precious metals suffering. So with that, I would like to bring in our panel, and I'm going to start with you, Samir. I'd like to get your thoughts on, the AI theme. It's definitely been one of the dominant themes in the markets this year, and it's been driving a lot of this CapEx spending, earnings growth, market leadership. The information technology sector, though, is down about 9% just this week. Do you think we're starting to see investors question the viability of the AI trade, or is this something else?
Yeah, great question, Tracy. And in some ways, it's maybe the existential question for markets right now. And I guess, the short answer would be yes, they are questioning the viability of the AI trade. If we define the AI trade as this almost kind of, video game glitch where every day we were coming in and, semis were up 2-3%. Yeah, I think that part of the move is probably over. Personally, I could have argued that it probably should have never happened that way in the first place. It showed probably some undisciplined chasing, of performance on the part of a lot of retail traders, who were probably going after kind of the momentum there. They earlier in the year they showed up in gold, and once gold started to fizzle out, it seems like they shifted to semis, and I would argue from here, you probably are looking at a little bit of a pullback. I think the framework I would use though is whether it's a pullback within a broader uptrend or whether it's the start of some kind of trend change. And I would say our framework would be one where we get a pullback. And it probably means that as those doubts grow, whether it's on the spending, whether it's on some of the equity issuance, whether it's on some of the revenue and earnings projections, I guess maybe the way I would frame it is that we would add exposure on doubts, and we would trim exposure when you get to kind of the can't miss part of these moves. So, if people recall, in October of last year, we went neutral on technology because it seemed like it couldn't miss. And then, pretty much since then it underperformed into kind of the late March low for equity markets, at which point there were quite a few doubts around things like software, AI more broadly. We went back to favorable on tech, and I would argue we are now back to, or at least were until about a week ago, to this can't miss part of the story. It's hard to tell how far we'll pull back, but your kind of asset and sector allocation should be your North Star, your guide. If you're below those allocations, you should be adding on weakness. If you're above or at those allocations, you should just be maintaining and or trimming on rallies. Eventually, I do believe any pullbacks will kind of be arrested by earnings, which will provide kind of the support for equity prices over the intermediate to long term, like they did over the past couple of months, starting in late March. You could also look at some of the other sectors we like, financials, industrials, and utilities, as other areas that will benefit from the AI build-out. They're maybe not as popular a trade, but I do think over the long run they'll help with things like IPOs, equity issuance, debt issuance, capital markets more broadly, the AI build-out with respect to data centers, the power generation. So I would say there's more than one way to kind of play the AI theme, and right now some of those ancillary areas seem to be kind of a better bet. For what it's worth, since June 2nd, when tech peaked on a relative basis, there's only one sector that's been underperforming, and it's technology. The only one that's even close as a second to being an underperformer is discretionary, which we're unfavorable on. So for what it's worth, it shows you that tech has become so big, there are times when it can be the only sector to outperform or underperform. So again, don't want you, leading more than you should be in that particular area.
Okay, thank you, Samir. So do you think that the IPOs that are coming to market had something to do with the sell-off in technology? Do you think that's just possibly making room for exposure to those in the portfolios?
I'm sure that's part of it, and it doesn't help that, at least from the sounds of it, Standard & Poor's will not be adding a lot of these IPOs to their benchmark indices until they've been around for at least a year. So, one of the things that you'll see if you kind of get into the nitty-gritty mechanics of markets is people could be selling things that are in the S&P 500 to fund something that will not be in that index, at least for, possibly as long as a year.
Right. Okay. Thank you, Samir. Appreciate that. Veronica, I'd like to come to you now. So maybe you can tell us how you keep clients' exposure to these equities without over-concentrating.
Yeah, absolutely, Tracy. I think that's one of the top questions that we get during the periods of time when tech is really outperforming. So we've seen that cool down a little bit recently, and I think it's highlighting some of the other opportunities that we see to really invest in the AI trend because we do think that it's a powerful long-term theme that has a little bit more room to run, and it's certainly going to be broader than just the Mag 7 or just the tech space in general. So, there's been a lot of attention just in that mega cap tech space, but there's really an entire ecosystem that's developing around the AI theme. And Samir touched on this a little bit. It's going to span across sectors to areas like industrials, materials, and utilities, with those companies that are building out the infrastructure that supports AI. So whether that's data centers, power generation, or the supply chains, there are going to be a lot of areas benefiting from this long-term trend. And even outside of equities, things like industrial metals and the commodity space and data center REITs should also be beneficiaries. And so just instead of trying to concentrate the portfolio in a handful of names that might be getting a lot of attention in the news, we encourage a more balanced approach to benefit from this theme, where you've got some direct exposure because we do still like tech, but you also complement it with those other areas that Samir and I mentioned that should benefit. The other point that I want to make is that the expectations for AI are very high right now. And I don't think that means the story is over. We're probably still early in that theme. But it does mean that the markets are going to be ultra sensitive to any news that comes out and whether or not earnings continue to keep up with expectations. And I think that spotlight is very hyper-focused on tech right now. So that makes that diversification outside of tech even more important when we're thinking about that earnings impact. And then the last piece I want to touch on is really just about being disciplined with the portfolio. During periods when we have a strong run, it's easy for certain positions to become a larger part of the portfolio than you might intend, especially with a sector like tech, which is already very significant within the U.S. equity indexes. So it's always good to take a step back, rebalance, look at what your exposure is compared to where you'd like it from that sector allocation. Our goal isn't to avoid the theme here. We're encouraging investors to remain participated, just in a way that's going to be balanced and diversified and sustainable over time, and also providing the benefits in those areas that might be getting a little bit less attention right now, but should start to get more attention in the future.
Yeah, that's great advice, Veronica. Thank you very much. Brian, I'd like to bring you into the conversation now. You are head of our fixed income strategy. Do you see AI showing up in the fixed income markets?
I mean, when you look at the fixed income markets, what they're saying about the economy, and saying the economy is relatively good. I think the big question with AI comes with what be answered in the future, and that's, what kind of productivity gains do we realize, and does that have the ability to keep inflation, relatively tamed? I think that is some of the thinking of Kevin Warsh, the new Fed chair, but really that'll be answered in the future. But the potential is there.
Yeah, that's a good tie-in there, Brian, to productivity and how that might impact the fixed income markets as well. Another theme that we have been following is resiliency. Every time we've seen the market pull back this year, Samir, buyers have come in and they've pushed it back to new all-time highs. And, it didn't matter whether the concern was software obsolescence at the hand of AI or whether it was the war in the Middle East. It didn't really seem to be able to keep the market down for very long. So, what do you think is behind this resilience? And do you see risks associated with, the rapid turnaround that we've seen since April? Or, even with the new attacks that are slated for Iran?
Yeah, I mean, I would say, for all the talk of AI, I think it may surprise some people to know that the resilience in large part is due to the consumer economy. As long as that holds in, I mean, just as one example, retail sales are running at 5.7% on the control group, which is a wonky way of saying that's the part that goes into the calculation of GDP. So 5.7 is a pretty healthy number. Now we can argue about how much of that is volumes and how much of that is companies pushing through pricing, but what it tells me is that the upper part of the K-shaped economy just keeps spending, and AI is holding up the manufacturing and construction side. So it's hard for me to see the markets losing that resiliency without some meaningful deterioration, probably in the labor market. Not seeing it yet, like if you look at JOLTS, which are job openings and labor turnover, or the last payrolls data, I mean, they would both suggest that the labor market is okay. I mean, maybe not great, but it's definitely not falling off any cliffs. But I think that's one of the most critical pieces to the puzzle, is that as long as the economy keeps going along okay, I think AI will be kind of the story that we hear about, because that's where the faster growth lies. But I think the true trend that this is all built on is the fact that consumers keep spending. I'll give you one more anecdote. If you look at kind of what's happened to a lot of the airlines, right? That's where a lot of the fuel prices have pushed their jet fuel prices higher. And, all the airlines have basically come out and said that they aren't seeing any issues with respect to demand for flights. So, that's maybe the best example that, when you see shocks, the consumer just kind of keeps on chugging along. So, what are things that could derail the economy other than the labor market rolling over? The conflict in the Middle East, if oil were to get meaningfully north of 120, right, that's the area we saw recently. It's also the area that we saw back in 2022. Obviously, now that we've seen 120 a couple times, that by itself has not been enough to drive us into a recession. So it would have to be something north of 120, and it would have to be sustained. Arguably, it could be something in the ballpark of $150 to $200 a barrel oil, given the price inelasticity, which is, again, a fancy way of saying that people will do a lot of things before they stop buying gasoline and driving around. So given the price inelasticity, you may need something, $150 plus on oil for that to be a shock that makes the consumer roll over. So again, could you see a pullback, within that resiliency? Absolutely, but it's just very difficult for me to see a trend change without some of those kind of big rocks, changing in a meaningful way.
Yeah, you've really been talking all year about the potential for some volatility and viewing that as an opportunity as opposed to, something more serious that could cause us to potentially underweight equities.
Yeah, and to that point, I mean, look, I love frameworks. Like, what I would tell people is, look, it would not surprise me if we've seen the pre-midterm high in markets. Again, doesn't mean that we won't go higher over time, maybe even as recently as, after the midterms. I could easily see us setting new highs, but it would not surprise me if for the next 4 to 5 months, all of these issues just kind of nag at markets, from the standpoint of, even if the Strait were to open yesterday, and I appreciate that I'm saying if the Strait were to open yesterday, it's going to take time for all these things to start flowing again. And a lot of that kind of uptick in prices, a lot of that inflation is already baked in the cake, and it's already gotten to the point where the Feds had to basically kind of recant rate cuts, and now at some point, if the market is to be believed, they may even have to consider rate hikes. So I think a lot of that has already happened, and I don't think the market, especially the risk markets, have caught up to that yet.
Right. Okay. Thank you, Samir. We'll come back to you. Veronica, when we see signals that are pretty mixed like this, how do you think about positioning portfolios right now?
Yeah, I think you and Samir made good points about the market being resilient. We've seen, pullbacks and then fairly quick recoveries. But then at the same time, when you look underneath the surface, those signals, like you mentioned, are a little bit more mixed. Growth is still there, but it's becoming a little bit more uneven. Inflation is becoming more of a factor. And then, of course, the geopolitical risks are still in the background. So all of that is going to be a breeding ground for continued volatility this year, which means that you'll have to have continued discipline when it comes to positioning portfolios and remaining aligned based on your risk tolerance and your investment goals. So, the first thing I recommend is actually really simple, but it can be hard in practice, and that is to just stay invested. One thing that has been consistent not only this year, but over longer periods of time is that stepping out of the market, even temporarily, can be costly, given how quickly markets can rebound, especially when they're reacting to geopolitical tensions. That said, staying invested doesn't mean being static with your allocation. It just means not trying to pick and choose which days to have market exposure. Instead, we recommend being disciplined about where you have exposure and what's going to be right for your goals. In general, that means just taking a close look at what you're holding and how everything's allocated. After a strong run in certain part of the markets, again, that's been really tied to AI throughout the past couple of years. But it's very common that when you see these things, the portfolios can become a bit imbalanced or have drifted from your targets. So it gives this as an opportunity to use it as a rebalancing environment rather than repositioning. So I just think it's really important to make sure that your allocation is aligned with your long-term strategy or with our shorter-term tactical guidance if you're following those recommendations. And from a diversification perspective, we continue to recommend that investors have a mix that includes equities for growth, fixed income for income and stability, and real assets and alternatives to help diversify. But that right amount within each of those asset groups is going to depend on your risk tolerance and what your goals are, as well as what our outlook is for the market and economy over the next couple of years. So I really recommend, having that conversation with your advisor to make sure that that allocation is where you like it, and then use these market moves as an opportunity to systematically rebalance to maintain that exposure. The bottom line here is that, we want investors to stay invested, stay diversified, and then stay disciplined around those two concepts. That's really what this environment is calling for.
Yeah, really well said, Veronica. Thank you. So, Brian, we've seen quite the backup in rates so far this year. The 10-year has risen more than half a percentage point since the war began. Obviously, a lot of that climb can be attributed to higher oil prices and then, the flow through of those higher commodity prices to other areas of the economy. But what does that mean for the Fed at its meeting next week under the new chairman?
Well, the meeting next week will be interesting. It's as you mentioned, it's Kevin Warsh's first meeting as chair. It's also a meeting in which we get the summary of economic projections. So that's the dot plots. See what the Fed's thinking, for the rest of this year and next year. Give us some good insight on what the different members are thinking. And we have had a shift since the last meeting in the sense that earlier this year, markets were pricing in potential Fed cuts. Now markets pricing in some potential Fed hikes. Our targets are flat. So we're suggesting the Fed remains on hold. I think it's going to be a really, really, really hard lift for the new Fed chair to come in and raise rates relatively early. That is not going to be an easy start to his tenure, and probably something he will choose to avoid if at all possible. So, what we'll be looking for next week, again, watching those projections, there is some thought that the AI, the productivity gains can help keep inflation in check, but the longer the war drags on, the longer that oil prices stay elevated, it becomes more and more of a concern in terms of the inflation picture. And the inflation trends higher, the Fed may be left with no choice but to raise rates to try to dampen that down. But I don't think we're going to get that next week. Again, this is going to be Kevin Warsh's first Fed meeting. I don't think he's going to come out and rock the boat in any way. It'd be a big surprise, I think, if he did. We'll get a better indication, though, what he's thinking after that meeting and what the committee's thinking after those dot plots are released. So very important meeting next week, and one that bond markets will be watching closely. In fact, all markets will be watching closely.
Sure. Yeah. Okay. So no rate cuts, no rate hikes is your expectation through the end of this year.
Yeah, right. That's our expectation through the end of this year. And clearly next week at next week's meeting, they're going to leave rates unchanged. I mean, that's very clear. We'll really just be looking at those indications. As I mentioned, the market's starting to expect some rate hikes, but we're expecting that the Fed stays on hold. So we'll see.
Okay, and we've got the 10-year now at about 4.54, I believe was the last number I saw, and the 30-year is now yielding over 5%. Is that pretty much in line with your year-end expectations for yields as well?
I mean, yeah, pretty much in line. I think as we look in from this year into next year, could continue to see those longer-term rates edge higher. But I'm not looking for any rapid movement in rates, but, markets change, situations change. It's something we'll watch closely. I would say the one piece of good news in terms of higher rates, typically, if markets become concerned about the economy, concerned about growth, you tend to see rates come down, especially at the long end of the curve. So overall, I think the bond market is saying that, maybe there's some concerns there about inflation, what's going to happen. But overall, employment and the economy remains on track. So, to see the rates continue to drift higher, I think it's very possible. That's why we are unfavorable long-term, looking for clients to really kind of concentrate more in those intermediate, or I think even short-term is an area that we may look to, improve our guidance at some point in the future, especially if it's clear that the Fed's going to remain on hold. So if you're getting 4.15 on a 2-year, that's not bad. That's pretty good for a pretty low volatile asset. So currently we're unfavorable short term, but really we put that money over in equities. And that's been a great trade because equities have done really, really strong since the beginning of the year, easily beating those kind of 3-4% type yields. But if you're a fixed income investor, you're looking to maybe be a little bit more conservative. We do recommend that intermediate part of the curve, but I think you can also look at the short end.
Right. Okay. Thank you so much. That's very helpful, Brian. Samir, I do want to ask you a question about these rates. The equity market seemed to be sensitive to that 4.5% up until this particular time when we're seeing the 10-year hit that 4.5% level. That's because they tend to discount at that higher interest rate. But then the flip side of that is that inflation can in some ways actually be good for stocks. Do I have that right? It's kind of a tricky combination.
Yeah, I mean, history tells you that as long as inflation is kind of 4% or below, it actually gives companies a little bit of a tailwind with respect to their top line growth, right? If you think about CPI, which is consumer price inflation, if you think about that as basically the growth rate of the top line for companies, 4% is a healthy, top line growth number. And if you can manage your expenses or maybe even cut your expenses, you can get a lot of that 4% to fall all the way to the bottom line, maybe even kind of, double or triple it, again, depending on what you're doing with kind of the expense side of the equation. But, there's no such thing as free inflation, right? It does come with those higher interest rates. And I guess what we're watching for in terms of how rates play with equity markets, history tells you there's about 3 things you need to watch. The first one is what's going on with kind of the short end. And, the 2-year has gone from around 340 to 415. Our work suggests that, once the 2-year jumps by about 50 basis points, over a short period of time, call it, a couple of months, history tells you that the equity market starts to really struggle with that rate of change. So I think, that's the first thing that we are watching. As I've mentioned, there's a couple of other factors that are also on the list, but this would be one more thing that may suggest that we've peaked until midterms. Two, you need to watch kind of the level of long-term yields. Now I'm pivoting to long-term yields. Those can be an alternative to equities, especially if they yield enough. But I don't think 4.5% on the 10-year is enough to dampen the enthusiasm for equities in a world where earnings are going to grow north of 25% this year and in the low teens next year. So I do think we're going to need to see something probably 5 or maybe even north of it. A lot of people talk about the late 90s. I think it may surprise them to hear that, the 10-year was closer to 6 than it is at these levels in the late 90s, with multiples at much higher levels. So again, not saying this is a repeat of the late 90s, but it wouldn't be that unheard of to see rates, get to 5, maybe even north of 5. And then the third thing that matters with respect to interest rates and equities is the shape of the curve. Specifically, what are long rates doing relative to short-term interest rates? And the curve has been doing what we call flattening, which is short-term rates have gone up faster than long-term interest rates, which in essence makes things a little bit trickier for financial, especially banks, which tend to borrow short and lend long. So it's a lot of different things that we're watching. Again, I see it as one more thing that could dampen the equity markets for the coming months, but I don't see it as changing the trend. What could change the trend is if the market's right and the Fed's going to hike multiple times. That's one of those things that, as Darrell Cronk, our CIO, likes to say, could be one of those things at the scene of the crime if markets were to change trend would be Fed rate hikes. I think markets would view that as, all right, party's over. It's time to take more meaningful profits. I would point people back to 2022 as the last time that happened, and clearly that was one issue. The other one, as we've talked about, would be some kind of meaningful financial tightening on the part of markets. Right, there was a credit crisis. We've kind of lived through one of those. That would be problematic, or again, just a recession either on the consumer side, or it could be this time it's some broader reversal in the AI spending. Again, hard to see right now given how easy it is for them to find funding, but again, these are just some of the things we're watching.
Right. Okay. Thank you very much, Samir. And I'd like to thank all of our panelists today. We have quickly arrived at the top of the hour, but I would like to thank Samir, Veronica, and Brian for your participation today. Really helpful commentary. And I did want to remind everyone again about that mid-year Outlook client call. That's next Wednesday, June 17th at 4:15. Eastern Time. Calls are going to continue for the state of the markets through 2026. We're going to have those on the second Wednesday of every month. The next one is Wednesday, July the 8th. And then, of course, we'll have these calls as needed. We can always schedule an ad hoc call if market conditions warrant that. So we could have a volatile summer, as we've discussed today, and we'll certainly look to schedule those calls if necessary. As always, we're very grateful for your business. We appreciate your time today. And with that, I will turn it back over to Michelle. And Michelle, we can close out today's call. Thank you.
Thank you. This concludes this afternoon's Wells Fargo Investment Institute State of the Market Monthly Roundtable.
Forecasts and estimates are not guaranteed and are based on certain assumptions and on views of market and economic conditions which are subject to change. Asset allocation cannot eliminate the risk of fluctuating prices and uncertain returns. Different investments offer different levels of potential return and market risk. The level of risk associated with a particular investment or asset class generally correlates with the level of return the investment or asset class might achieve. Stock markets, especially foreign markets, are volatile. Stock values may fluctuate in response to general economic and market conditions, the prospects of individual companies, and industry sectors. Foreign investing has additional risks, including those associated with currency fluctuation, political and economic instability, and different accounting standards. These risks are heightened in emerging markets. Bonds are subject to market interest rate, price, credit default, liquidity, inflation, and other risks. Prices tend to be inversely affected by changes in interest rates. Although treasuries are considered free from credit risk, they are subject to other types of risks. These risks include interest rate risk, which may cause the underlying value of the bond to fluctuate. Municipal bonds offer interest payments exempt from federal taxes and potentially state and local income taxes. Municipal bonds are subject to credit risk and potentially the alternative minimum tax, AMT. Quality varies widely depending on the specific issuer. Municipal securities are also subject to legislative and regulatory risk, which is the risk that a change in the tax code could affect the value of taxable or tax-exempt interest income. The commodities markets are considered speculative, carry substantial risks, and have experienced periods of extreme volatility. Investing in a volatile and uncertain commodities market may cause a portfolio to rapidly increase or decrease in value, which may result in greater share price volatility. Real assets are subject to risks associated with real estate, commodities, and other investments, and may not be appropriate for all investors. Investing in gold, silver, or other precious metals involves special risk considerations such as severe price fluctuations and adverse economic and regulatory developments affecting the sector or industry. Sector investing can be more volatile than investments that are broadly diversified over numerous sectors of the economy and will increase a portfolio's vulnerability to any single economic, political, or regulatory development affecting the sector. This can result in greater price volatility. The energy sector may be adversely affected by changes in worldwide energy prices, exploration, production spending, government regulation, and changes in interest rates, depletion of natural resources, and risks that arise from extreme weather conditions. Investing in the financial service companies will subject an investment to adverse economic or regulatory occurrences affecting the sector. There is increased risk investing in the industrial sector. The industries within the sector can be significantly affected by general market and economic conditions, competition, technological innovation, legislation, and government regulations, among other things, all of which can significantly affect a portfolio's performance. Risks associated with the technology sector include increased competition from domestic and international companies, unexpected changes in demand, regulatory actions, technical problems with key products, and the departure of key members of management. Technology and internet-related stocks, especially smaller, less seasoned companies, tend to be more volatile than the overall market. Utilities are sensitive to changes in interest rates, and the securities within the sector can be volatile and may underperform in a slow economy. The information contained herein constitutes general information and is not directed to, designed for, or individually tailored to any particular investor or potential investor. Do not use as the sole basis for investment decisions. Do not select an asset class or investment product based on performance alone. Consider all relevant information, including your existing portfolio, investment objectives, risk tolerance, liquidity needs, and investment time horizon. Wells Fargo Investment Institute Incorporated is a registered investment advisor and wholly owned subsidiary of Wells Fargo Bank N.A., a bank affiliate of Wells Fargo & Company. Wealth and Investment Management, WIM, offers financial products and services through bank and brokerage affiliates of Wells Fargo & Company. Bank products and services are available through Wells Fargo Bank N.A. Investment products and services are offered through Wells Fargo Advisors, a trade name used by Wells Fargo Clearing Services, LLC, and Wells Fargo Advisors Financial Network, LLC, members SIPC, separate registered broker-dealers, and non-bank affiliates of Wells Fargo & Company. Wells Fargo Advisors is registered with the U.S. Securities and Exchange Commission and the Financial Industry Regulatory Authority, but is not licensed or registered with any financial services regulatory authority outside of the U.S. Non-U.S. residents who maintain U.S.-based financial services accounts with Wells Fargo Advisors may not be afforded certain protections conferred by legislation and regulations in their country of residence in respect of any investments, investment transactions, or communications made with Wells Fargo Advisors. Wells Fargo Advisors is a trade name used by Wells Fargo Clearing Services, LLC, and Wells Fargo Advisors Financial Network, LLC, members SIPC, separate registered broker-dealers, and non-bank affiliates of Wells Fargo & Company.